The purpose of this video is to give you the big picture on the relationship between monetary policy, output, and inflation. So as you've seen before in this course, I like to show you this business cycle. This is how the economy works over time. It has in the past. And so we can put a trend, right, a trend line, a nice straight trend line through this. And economists often call this YP, potential GDP, where the economy could be potentially without any stresses. So YP is what's considered to be a long-run relationship, long-run equilibrium right here. When we deviate from this long-run equilibrium, it's called the short run. And when we're on this line, it's long run. So when we're away, either positive or negative, the economy tends to want to gravitate back towards long-run equilibrium. And so what is this potential GDP? Well, it's the economy's ability to produce output, assuming resources such as labor, capital, and technology are utilized at normal rates. There's no stress, there's no shortages, there's no surpluses. Economists like to believe that there is this unobservable, you can't actually measure it. You can try to estimate it, but you can't go out and try to actually document it. So people project what this potential GDP is. And economists like to think that there's a natural real rate of interest associated with that. And so you're going to hear that term. So if we can keep interest rates at this nice stable real rate, which may vary a little bit, but it's relatively stable, we can stay on this line. Economists also like to think that we have what's called full employment GDP. And so if we're on this line, we still have a bit of unemployment, but we consider ourselves to be at full employment because at any given time in the economy, there's always about 3% to 4% of the workforce looking for a job. They're searching. So it takes a while for people to find a job and for businesses to find laborers. So there's always going to be that little bit of 3 to 4% of people searching for jobs. So that's what we call full employment. Now, what happens when we're up here? It turns out, and we're down here, turns out when we're way up here, it's more likely the further we get away from this line and we go up, the harder we crash. And we crash down further and faster. And it's believed that the further we crash, the faster we rebound. Generally, that's what's thought. Not always the case, but that's what's thought. Now, what's the problem with having a really strong economy? This sounds great. There's problems that cause us to drop down. The problems are stock market bubbles, bond market bubbles, which tend to pop, real estate bubbles that pop and bring us down, which destabilize the economy. People start borrowing too much money. They leverage themselves up to the point of not being sustainable. Interest rates rise. Lending practices become lax. Inflation increases as we see shortages pop up. And all of those things combined often causes the bubbles to pop and the economy to drop down significantly. And when we're down here, we tend to have low inflation. Maybe sometimes negative inflation for a very short period of time. We get massive unemployment. We get deleveraging. Banks slow down on lending at this point. But eventually the economy rebounds. Eventually we snap back and we go through the whole cycle again. So what we want to do in the next series of videos is better explain and tie this whole graph together, because you've seen this before. But we need to explain how the whole thing works. And why is it that we deviate? Why can't we be on this straight line? That's the purpose of the next couple of videos. Now, before we start the aggregate supply and aggregate demand modeling graphs, let me show you the quantity theory of money again to give you a little more background, especially as it relates to long-run inflation and long-run equilibriums. Let's look at the concept of long-run inflation. And what I want to do is I want to use the money equation that we've seen before, where we said that, look, you have price times quantity, and that's real quantity of goods and services. Sometimes we just label it as Y, as output. And then we have this equal to the money supply times the velocity of money. So you remember the story. If this is GDP and this is $20 trillion, this right here, right? Then we have a certain level of money supply. Let's say the money supply is $2 trillion. That means the velocity, the number of transactions that have to happen, how often does money turn around in the economy? Well, if the economy is 20 trillion in a year, the money supply is 2 trillion. That means velocity has to be 10. So there's going to be 10 transactions per year using this 2 trillion to get to the 20 trillion. Now, that's nice, but let's put it in a little more convenient form. And we're going to put it in an addition form. We're going to say the percentage change in the money supply, right, plus the percentage change in velocity, I'm going on this side first, equals the percentage change in prices, that's inflation, plus the percentage change in quantity, which I'll call Y for now. That's output. So this is real increase in GDP. So what we're going to assume is that in the long run, the velocity of money doesn't change. The number of transactions that happen doesn't change. There's no increase, decrease in velocity, constant. Now, when you do that, let's do a little bit of math and see what we can tease out here in terms of relationships. If we rearrange this, we'll see the percentage change in price equals the percentage change in the money supply, it's money supply growth, minus the percentage change in Y. And we could call this, since we're looking at the long run inflation, call this potential, because that's where we want to be, on that straight line, potential. This shows you the relationship between inflation, the money supply, and output. And what we're going to do is we're going to explicitly relate these two in a graph, and then use money supply in the middle to try to explain how the economy works. Let me show you. So we're going to use what's called the aggregate supply and aggregate demand model, and here we're going to model it with inflation. Inflation is the percentage change in price for goods and services, and here is output, real output. And we're going to have potential GDP, that trend line that I was showing you a minute ago, is going to be here. And it's fixed. Let's call it 20 trillion. That's the value of goods and services produced in the economy. And what this line is saying is, look, inflation goes up and down. We stay fixed at $20 trillion worth of output. Now, that by itself doesn't tell you much. We need to put over top of this an aggregate demand curve. And aggregate demand equals consumption plus investment plus government expenditures plus net exports. Exports minus imports. So this is the aggregate demand curve. It's downward sloping. Okay? Downward sloping. And we have an equilibrium. Supply equals demand, so to speak, because this is output being produced by producers, and then you have demand by consumers and businesses and government to purchase goods and services. Now, let's imagine that there's a sudden increase in optimism amongst the business community and individuals. They start consuming more, and businesses start investing more in property, plant, and equipment. Since this is originating not because of a change in inflation, but because of just optimism. The aggregate demand curve shifts out. Call it D1, AD1, let's call this AD0. And we'd end up to a new equilibrium. Okay, so remember that if you change this number, the inflation rate, you ride along these curves. I changed optimism, and I said it went up, and so the aggregate demand curves, it's a shifter for the aggregate demand curve. And I'll build that out in a little bit, because I'm going to have videos for each one of these curves that I'm going to show you. Now, according to classical economists from years ago, if you have an increase in aggregate demand, output doesn't change. because prices just end up going up. And if prices go up, it's too expensive for people to buy certain goods. Output doesn't change. So an increase in pressure from optimism here, aggregate demand curve up, nothing happens. We move right up and down this line. We don't get any surpluses, any shortages. We don't get any inflationary, what's called an inflationary gap. We don't move to the right. We don't move to the left and have a deflationary gap, or what's called a recessionary gap. We stay right at full employment. But Keynes said that's a pile of crap. It just doesn't make sense. He looked at what happened at the Great Depression, and he built his theory based on what he saw in the Great Depression of the 1930s. And he said, whoa, that doesn't make sense. We went like a decade with super high 25% unemployment, 15% unemployment. It was really high for a long time. How the heck can prices adjust so that we stay right at full employment? Doesn't make any sense. You got to go back to the drawing board. And what ultimately came about from Keynes's work is, look, there is a short-run aggregate supply curve. This guy is called the long-run aggregate supply curve because this is what we gravitate to. We gravitate to full employment. But in the short run, we're on this curve, which is upward sloping curve. And so if we start here at equilibrium, this point, and there's an increase in optimism, the aggregate demand curve shifts, but instead of going right up to this point, we end up going out here, which means prices did not fully adjust. They only partially adjust, because if they fully adjusted, we'd be up here. Not only did they not fully adjust, but we didn't stay on this full employment line. We ended up going into what's called an inflationary gap. And we have an inflationary gap. There's going to be pressure for prices to go up. And eventually, but not immediately, wages. So the reason for this upward sloping supply curve is that there is what's called sticky factor prices out there. And prices, like the price of labor is wages, and the price of capital is often called rent. So businesses have sales, they have cost of goods sold, which includes rent and wages. They have gross margin, they have selling and administrative expenses, and they have profits. Simple income statement. Now, if inflation changes, this changes immediately because the price of goods and services changes immediately. But wages and rent tend to be sticky. And what do we mean by that? Well, people don't get reviewed for at least a year in many, many cases. So they don't see raises for at least a year, sometimes longer if you belong to a union. And rent doesn't change for at least a year. In some contracts, it goes out even further. So if this is a change in 1 month, let's say there's optimism and this demand curve shifts out in 1 month, wages aren't going to change for the most part, and rents aren't going to change much. So we don't get this ultimate increase in prices that would work its way through. We end up at this point, and we have inflationary pressures at that point. There's pressure for prices to go up. In fact, they've already gone up. These prices right here have gone up. There's going to be pressure on wages and rent to go up because we're getting shortages. The economy is stretched beyond its normal level, normal utilization of resources. So when this happens and we start to see inflation going up, people begin to get a different set of inflation expectations. And what's important to realize is this curve is based on a set of inflation expectations. Okay? So we say this is short-run aggregate supply curve 0. When people start seeing inflation going up, they form higher expectations about future inflation. And the short-run aggregate supply curve shifts to the left. And we go this way. And here we are at point 3, back to equilibrium. So, start out again, equilibrium. There's an increase in optimism in the economy. It shifts the aggregate demand curve. It shifts the aggregate demand curve. We don't move along the aggregate demand curve because we're not changing inflation. Here, we're not changing inflation. Okay? But this causes inflation. So we move up, it causes inflation, and people see that. They start to change their expectations that inflation is going to go up. and it shifts the aggregate supply curve, so we move in this direction. Now, again, why, when prices start to go up, why do we see an increase in output? Why do businesses increase their output here? Well, if sales go up, the value of sales go up just because of inflation, and your cost of goods sold is relatively fixed and sticky, that means your profits are going to go up. So businesses have an incentive to increase output when prices go up because their rent and their labor is kind of sticky. There will be inflationary pressures that are going to come about, but they take time to work their way through the economy. When they work their way through the economy, expectations about inflation changes, goes up, and here we are right in the long run at 0.3, no change in output. So what that says is we just went up this area and we've just come back down. What I'll show you later on is what happens when there's pessimism. Well, if there's pessimism, the aggregate demand curve shifts to the left. Inflation has a tendency to go down. Inflation expectations change and the aggregate supply curve shifts down to the right. And we end up at a different new point down below here. But we're still at full employment. Now, this curve, I haven't fully explained this curve. In fact, I have a whole video just developing this curve. It's actually called the dynamic aggregate demand curve. And the reason it's called the dynamic aggregate demand curve is because when the Federal Reserve sees inflation changing, you're going to move up and down this aggregate demand curve. That's why this aggregate demand curve is downward sloping. It's downward sloping because if the Fed sees inflation going up and you're moving along this axis, it means the Fed is going to increase real interest rates to slow the economy. So when we're at this point, right? So we get here, it can take years to get back. That's Keynes' argument. We're out here, there could be high inflation for years. So how do we get back to here quicker? And so how can we even like circumvent that and kind of go up without getting too much in terms of shortages and just get right to the long run? That's what monetary policy is about. Monetary policy is about trying to get rid of these ups and downs. So my point in this video is just to show you the big picture. This is the big picture. Inflation, output, a long-run aggregate supply curve, a dynamic aggregate demand curve, and a short-run aggregate supply curve. Inflationary gaps, recessionary gaps. That's the big picture, along with sticky wages. So the next video, it's all about this demand curve. It takes a while to build it. I got to show you an aggregate expenditure curve. I got to show you the monetary policy reaction curve. And from that, I'll build this line. And then I'll have a whole video on this short run supply curve and build it out and describe sticky wages a little bit more. And then we've pretty much covered in those two videos, we'll cover the conversation about what this long run potential is. And then what we'll do at the very end is we'll look at various scenarios in the economy that has actually happened and see how to put it all together and explain the economy and what we can do to improve the economic outlook for us.